What's really happening right now is affordability of homes when it comes to interest rate, price increases, everything else.
Welcome back, everybody, to another Hey Pops financial video. I am your co-host, Mitch.
And I'm Larry.
We have
or Pops.
Pops, as we like to call him, affectionately, at least to his face. We won't tell you what we call him behind his back.
Thank you.
But our guest here today, Jeremy Bridwell, is a good friend of mine. We've known each other for, 12 years now?
Yeah, right about.
It's been a minute. Jeremy is absolutely awesome when it comes to a lot of things. You've started, sold businesses, tons of years of experience in sales. But what we're talking to him about today is his experience in real estate, which over 10 years now of real estate experience. We're talking buyers, sellers, investors, commercial as well.
A little bit of commercial, primarily focused on residential.
On residential, right?
And then working with new construction and the iBuyer firms.
That's right. And iBuyer, that's like those cash offer places where they're like, hey, we'll just pay you cash and then.
Absolutely.
Can you explain that a little bit to us? Because I know that as like an iBuyer home, I know that we were talking about that and we were just kind of like, what exactly is an iBuyer?
Yeah, absolutely. So there's a couple of name brand firms out there as well as some smaller, really market specific companies. But really those are going to be those ones that you see advertised on late night TV or radio talk shows that are saying, hey, we'll buy your house for cash, give us your address and we'll draft an offer. With those, they'll just that. The different firms have slightly different practices, but essentially at the end of the day, it's a quick way to sell off your home if you're in a haphazard situation that really requires some predictability or some extreme timeliness to get through the transaction.
So the benefit of doing that versus putting it up just on your own.
On the MLS or selling it traditionally.
There's pros and cons for every situation. The big thing there, you're going to have a couple different demographics, right? You're going to have people that need to sell their home right away. You're going to have people that are whether that need to sell immediately is because you already have another home you're buying and you may have a contingency that's about to expire. And so you really need to have a contract on the house quickly to make sure that the next home you're purchasing is still advantageous for you. It can be job loss scenarios where it's going to start impacting credit, affordability isn't there, or even a lot of relocation firms do them. They are an excellent resource when you're in a bind, or even if you're going to be buying a home, new construction, right? You're going to whichever builder is your favorite, and you need to have your home sold in order for them to start construction on your new home. It's a great way to get your home under contract and have 9-10 months in some cases to do that, although a lot of them have shortened down their time frames to about 120 days for closing.
Oh, awesome. Well, that's great. We've got more questions here. We really want to give as much insight as we can for all of you guys for what the real estate market looks like. Because I know over the past 4 or 5 years, it's been all over the place. You have a ton to buy. You have not so many to buy. You have interest rates up here, interest rates down there. And so we're gonna go over a lot of those questions. And so I hope you guys are excited. Make sure you like and subscribe for more videos like this before we get into it. All right, so let's go over some of these questions here and we'll just shoot them back and forth, between me and Pops here, and then we'll just dissect them together. So question number 1 is, what are the key factors driving the current state of the housing market?
So that is a very difficult question because it's more or less what's not driving those factors. What's really happening right now is affordability of homes when it comes to interest rate, price increases, everything else. During COVID in that 2020 to 2022 frame, in Arizona, for example, your average appreciation was like 43% in the value of your home.
Oh, it was wild.
And granted, at that same time, the inflation that you experience at the grocery store countered that. Oh. And so I like to refer to that as monopoly money or monopoly equity, if you will. Yes, your home was worth $250,000 in 2020. Today, that same home is going to be in the high fours, potentially low mid fives, depending on what part of town you're in.
Right.
But at the same time, if your grocery bill went up by 30%, you're really not outperforming the inflation in any other aspect.
Interesting.
Just on paper, it looks like you've received a lot more value in your home.
Interesting.
Other factors that might affect the cost of homes?
There absolutely are when it comes to it all is primarily going to curtail back down to inflation, because you have your cost of lumber, you have your cost of labor, you have your cost of all overall goods is just going through the roof. And so really inflation is the biggest number. The other half to that is obviously going to be interest rates, what your cost of getting that home and what you're paying in bank rates and expenses there in comparison to the principal that you're paying down on the home as well. That has absolutely gone through the roof. But again, that is also curtailed primarily from inflation.
Let me ask a question about interest rates. I know that we're about 6% right now, plus
Give
or
or take.
minus. I've seen them drop a little bit over the last month or two. Historically, 6% is not that much.
Right.
I'm old enough to have remembered 15, 18% interest rates during the 1980s. And so compared to that, we're still low, but we had so many years where interest rates were so low.
Correct.
That people panicked when it got to 5 and 6%. What's your take on that? Where do you think we are historically with interest rates?
So historically, when you look at just the mathematics of the number, 100% understand the difference in variation, that this really isn't a terrible rate when you look at it from just the interest perspective, right? 6% in comparison to, you're right, 18, 19, 20, mid 20% in the early to mid 80s. I know
insane.
My parents' first home they bought when they were pregnant with me, I believe it was a 19.5% interest rate.
Oh,
see,
right?
and then my house, what we were able to refinance super low during all this,
Yep.
with the rock bottom, it's like 2.87,
Right.
something like under 3%. It's insane.
But where the problem really lies in is that when my parents bought their first house for 19.5% interest, they were paying 19.5% interest on, I want to say it was $65,000.
Right.
In comparison, and mind you, so that house there was a 4-bedroom, 1,900 square foot home in the heart of Chandler at the time. It was an almost brand new home. And so for that payment, yeah, it was a 19.5% interest rate, but it's a lot easier to absorb. When you're talking that same home today, if it were sold in the market, that exact same home, after being, 42 years old, that same home would go on market for $475,000 without renovations.
Right.
So
that higher interest rates makes
100%.
Much different.
It's a lot easier to eat 19% on $75,000 than it is to eat 6% on $500,000.
That makes sense.
So when you really factor in compound all the different aspects of what that interest rate really means, it really, really causes damage to affordability, especially when the take-home salary of American Joe has not inflated to compare.
Not to that degree.
No, we're talking 3 to 5% annual, where inflation is skyrocketed through the roof.
Right.
It depends on what list you look at as far as what they calculated for your affordability. But I know for you guys, $75 used to fill up my shopping cart just 3.5 years ago at the grocery store.
Not even.
$75 gets me
That far now.
2 meals
No, and especially
for my family.
with 6
So.
kids.
Yep.
It's insane. If I spent $75 on a cart of groceries, I'd be through the roof. I can't spend less than $150.
Do you think the housing market is on the verge of a crash, or is it just a temporary correction?
Ooh, good question.
I'll be perfectly frank. It depends on what happens politically speaking at this point in time. From my perspective, and no matter what side of the aisle you're on, from a fiscal perspective, who's in office and who's really more importantly controlling all of the offices, not just president, is really going to interpret what's going to happen. Is there a possibility for it to go either way? Absolutely. The probability is that this is going to be more of a painful short-term decline that we really more or less just as Americans are going to have to accept that it's what we're at and accept it as our new norm before we see anything start moving.
Oh, interesting. But not something like 2008, for example.
Oh, no. No, there in 2008 you had actual fraud happening within the banking system, right? You had loans that were just by declaration only. I could walk in and say, I make $250,000 a year when I really only make $30,000 a year at Circle K.
They're like, you seem like an honest guy.
They wouldn't verify half the information.
Wow.
Gosh,
That's what caused the massive inflation and burst at that point in time. Where we're at today, we have regulations in place to ensure that there is a lot more accuracy in what's happening with the lending. And so really what we come to now is this balance of affordability, right? As interest rates drop, we're going to see a high influx of buyers trying to enter the market and trying to get their mortgages and loans before another acceleration happens with the interest rate. If we don't see an interest rate drop, we're going to see the value of homes drop because, again, supply and demand.
Right.
If we don't have enough demand for the homes, you're going to have to reduce price. I do think we're going to see another reduction in home values happen over the next 12 to 16 months. I think it's just inevitable for the state of the world at this point in time, but it's not going to be severe. We're talking maybe a couple percent, just enough to stabilize the market so we can have a healthy growth pattern again.
So you're saying it sounds like that correction will be more because houses are overpriced, if you will. Real estate's overpriced right now, as opposed to, we've got an election cycle, obviously, we're in the middle of and going to culminate in November here in a couple of months. It seems like the housing market doesn't necessarily respond to new regulation as much as speculation, worry, concern. It's such an emotional thing that drives the market in large measure. Is that what you're saying?
100%. When you think about it, when you're listening to a radio show, do they sit and talk time about regulation, or do they talk about either, and hate to use the term fake news, but headline news, I'll say,
Okay.
right? Headlines are what grab people. The media really controls the conversation
Especially
that's
negative
happening
headlines.
today, especially negative, and it's so easy to turn something negative these days.
Yeah.
It's just like, it's clickbait, essentially.
100%. It's the talk of the town there. And let's be honest, how many people sit down and actually read and have ever read page 3 or page 4 of a newspaper, right?
Right.
Or in the same essence, page 3, page 4 of a Google search result, or page 3, page 4 on Instagram. That's got to be if you're really, really bored or really trying to avoid your wife, that you spend that much time scrolling, So,
or those few that are really interested in it, but it's got to really capture your interest to take you that far into an article.
and typically in that situation, you're talking about far less than even 10% of the U.S. demographic.
Oh, 100%. 100%. Piggybacking off of interest rates, with interest rates being a lot higher than, say, what I had just a few years ago, is now a good time to buy a home, or should people wait? So I think that's what a lot of you guys are wondering about.
It truly depends on what your goals are. If it's a home that you are going to live in and you're hoping to sell off in the next 1 to 3 years, unless you need to, it's probably not the greatest time in the world because there is a lot of uncertainty. Now, the catch-22 to that is that it's never a bad time to buy. It really just depends on what your goals are. Right?
Go into that.
So if you look at your value today, and that's why I always say 1 to 3 years is always going to be a risk, no matter how great or horrible the economy is, right? Because you don't have enough time to grow that year over year equitable return on the property. If you're looking at a cash basis only, so for you buy, hold investors, someone looking to build a portfolio, something like that, if you're looking on the cash on cash return, it's not there right now. I'll just be perfectly candid. It's not there because if it's a foreclosed property, and frankly, if it's something going close to foreclosure, they probably have already received a cash offer that's going to be comparable to what you would offer from one of the iBuyers.
Oh, right.
Right. Those instant cash offers.
Right.
And so if they're in a bind where they're in that situation, most people still have some equity that they can get out of their house on the sale of a home. And so if they're experiencing financial hardship and they're getting close to having to lose a home, which is really when a traditional investor is going to be able to buy and acquire a home at a value that is going to get that cash return that they need if they're not looking at a 10, 15, 20-year hold pattern, it's probably already going to be sold without ever touching the market.
Interesting, yeah.
So
let me follow that up with a little question comment.
Yeah.
It sounds to me like you're saying, obviously, what your goals are important. Buying a home to live in, which many of us aspire to or have done, is one thing.
Mm-hmm.
Buying a home as an investment is a very different thing.
Yes, 100%.
And so you're saying, especially if you're buying a home to live in, and there may be a chance you're going to have to move in 1 to 3 years and sell it,
Mm-hmm.
now may not be the right time.
That would be a fair assessment, yes.
But if you're buying a home for investment purposes, there may not necessarily be a bad time. Obviously, there are times that are better than others.
Right.
And if you can scoop up a home that's distressed for a cheap price, it's never a bad time. But you need to look at those things differently depending on why you're buying that home.
Correct. And you need to make sure that whatever agent you choose is somebody who's going to be able to discuss that and honestly piggyback that with probably a financial planner, financial consultant to verify that the risk matches your portfolio strategy as you move forward.
Let me follow that up with another question then. You're licensed in a few other states other than Arizona. I know investors who have purchased properties, say, in the Midwest.
Yes.
Very different market than Arizona, which kind of follows the West Coast, both coasts for that matter. They appreciate dramatically. They depreciate dramatically when the market's bad too, but they don't cash flow nearly as well. Can you talk about, I call them cash flow markets versus appreciation markets? Midwest being a cash flow market.
Yep.
And ours in Arizona here. I'm in Utah as well. I live in Utah. Very much the same as Arizona. Can you talk about the difference between those two markets?
Absolutely. So an appreciation market is going to be one where you're really, really just simply relying on the long-term growth strategy of a property, right? You are looking at, okay, I'm in Gilbert. I'm going to buy this house. It's $560,000 and it's going to rent at $3,100 a month. Depending on the type of investment you're doing, if you're taking out any sort of financing, loans, or any of that situation, you're going to break even or possibly be at a monthly deficit for the first 1 to 3 years on the property. However,
until it appreciates.
Exactly. The best way I can explain and compare it is your 401k, right? You're not buying your 401k for performance in today's market. You're not taking it out for 15, 20, 30 years, right? And we know that historically, over the course of those years, we're going to have bumps and falls. We're also going to have massive jumps. And so we appreciate the long-term gain, even though the asset may not look good on paper today.
Cash flow wise.
A cash flow return is going to be one where, hey, I want to live off the residuals of this property today in my portfolio. It's one of the really big popular movements where people are doing a lot of homes in the Midwest is so that they can hurry up and go buy 10, 15, 20 houses because your risk factor is a little bit lower on your cash on cash. You have half the price of a home or even less than that than an acquisition in, say, Arizona, California, Washington, these other markets that are exorbitantly higher initial price points. So if you can buy 2 to 3 homes that are going to predictably bring you in $500 to $700 in residual cash flow per month, it compounds and it builds up really quickly. But your overall net worth is not really going to grow over the long term any larger than what the initial value of the home is. It's basically a wash.
Because those markets don't appreciate like Arizona, California have.
It's a now income strategy for the cash on cash as compared to an appreciation strategy being your long-term investment goals.
And so we're back to, why am I buying the house? We've talked about this already.
Yep.
You need to look at why you're buying the house and where you're buying the house because the strategies may be very different.
And being realistic to what you're going to get for the house at the same time. Just be perfectly frank. If you're looking at a cash on cash approach, as far as what your strategy is. You're buying a number. You're buying a statistic. You're not buying a quality necessarily. You're buying something that predictably is going to be in safe condition. You're buying something that's going to be in an attractive area and maybe a little bit better than what's around you, but not fully rehabbed, not beautiful. The key word is sexy. It's just, it's not going to be that wow factor that you would ever probably want to live in for yourself, but it's an investment model, right?
Good point.
If you're looking at appreciation, you're paying attention much more heavily to the school district, to the finish, to the granite counters, to the pretty wow stuff, that beauty factor that looks great in a picture. And so you really need to be realistic about that. You have a lot of people that try and enter the investment market by saying, I'm going to buy this house, I'm going to live in it for 2 years, because that way I don't pay capital gains when I move into another home and I save this, that, and the other. If that's your goal, is building a portfolio, you're not buying a beautiful house. You're buying a realistic house, because that home is going to give you a better annual cash return than the gorgeous house in the gorgeous neighborhood.
Right.
It sounds to me like you better not be buying houses on emotion.
100%. Unless it's a house you want to live in long term.
If you're going to live in it long term, and if you need to make mama happy, then buy the house that makes her happy. But you know, in any other scenario, emotion needs to be taken out of it. It's like buying a car.
It's math. Nobody gets emotional about, well, very few people get emotional about math. Right?
I haven't cried over math for a while.
Unless it's because your investments aren't returning the way you want. Then you're balling.
Then
like
I may be crying.
Don't like that kind of math.
But no, truthfully, in that situation, you want to make sure that you're paying attention to your goal, and more specifically, that who you have in your corner protecting you and working for you also understands wholeheartedly what your goal is and keeps you accountable to that.
Yeah.
And honestly, to piggyback on that point, having somebody in your corner, one of the things I really appreciated when I bought my home is having a real estate agent that was in my corner. He sold me my home.
Theoretically, they all should be, but
they're
not.
But unfortunately, even if somebody is, if you don't necessarily know them, sometimes it's a coin toss whether or not they are going to be in your corner, right? One of the things I really appreciated that Jeremy did for me is that every single little thing that I had a question about, you made sure that we understood exactly how everything worked before we pulled the trigger and actually bought the home.
Yeah.
That's huge.
And there are tons of amazing agents out there, right? The important thing, though, is to make sure that they truly are working for you and that what they have to offer is truly a fiduciary service, right? You go into a financial planner and you obviously want to get along with them. You're going to be spending a little bit of time with them, but you're really wanting to look at how well their investments have performed in the past, how well they do at protecting their clients. And we touched on this briefly in the past. It was like the lights in your kitchen, right?
Yeah.
They just want to replace light bulbs, and we made sure that they understood that that the lights had to be in operable condition. And when they replaced the light bulbs, they found out that 3 of the 6 weren't.
Right.
That would have been on your shoulders otherwise. So you want to make sure that your agent is prepared to do whatever you need to meet your goals.
Right.
So,
Jeremy, you mentioned the word fiduciary. Could you explain that for our audience?
Yeah. So fiduciary is more specifically going to mean that when I work for you, my job is to protect your best interest and work for your success rather than for my own. So, or for any agent's own, I should say. So with that, it means I'm not looking to get my commission check so much as I'm looking to help serve you as my client, ensure that your goals are met and satisfied. And in return, I'll be taken care of in the end, right? I don't need to worry about that because I'm doing the right thing for the people that I'm surrounded by.
Thank you. And I've heard that term thrown around, and some people love to trump the fact that they are a fiduciary.
Right.
When in reality, I'm not sure they have my best interests in mind anyway, even with that title. So we want to be sure when you're talking to real estate agents or any other financial advisor that they truly do have your interests in mind and not just their paycheck.
Yeah. The best agents out there are the agents that are happy to help you find the most affordable house that meets your goals, not the most expensive house, because they're looking for the long-term relationship, right? I love doing work with friends and family specifically because they don't ever have to question. And I want to validate to them that I always want to make sure that they have their best interest in mind. I want to be comfortable at Thanksgiving dinner. And that's the mentality that I take with everything. And a lot of agents do are, you know what, if we were to holiday party, would this be awkward?
Yeah.
Or would this be great?
Yep.
And if you would feel potentially strange with anybody, then that might not be the right person to work with.
Oh, I love that.
It sounds like an abundance versus a scarcity mindset.
100%.
And that's exactly what we look for, is an abundance mindset. There's plenty to go around.
Yep.
There are people, if it doesn't work out with you, and the next one will, and you please somebody, you'll get pleasant customers in return eventually. So
Yeah, we talk about that a lot in some of our later pillars.
we do.
When it comes to entrepreneurship and business ownership, as well as mindset is another pillar that we have, which we have talked a bit about, the kind of the metaphor of building a bridge.
Yep.
Right? They're built from both sides. You got your buyer, you got your seller.
Mhm.
You don't, instead of thinking how they can complete your bridge, think about how you can complete theirs.
Completely.
Because once the bridge is built, it goes both ways. Like you said, you'll get taken care of.
Yep.
But if you are focusing on them and what they need to complete that bridge, then they're going to be happier. You're going to get more referrals. You're going to get it's going to be better all the way around.
It does. That's the funny thing about business and entrepreneurship in general is, even if you want to look at it from a selfish perspective, right? The most selfish perspective in the world can also make you the most money if that's the way you're wired. Because if you are just in it for yourself, if you are in it for just your own goals, by doing the right thing for everyone else, you're always going to get the most return. So it's the gift that keeps on giving. By having a selfless servitude, right? By having that mindset and that focus, you're going to long-term receive more business and more growth, no matter what industry you're in.
So don't be short-sighted, essentially.
100%.
Yep.
In everything.
I love that.
And you can sleep well at night.
Yeah. And I value my sleep.
We know.
Oh, man. And I need as much beauty sleep as I can get. Let's just say that.
I gave up on that part.
Yeah. All right. How do you think the potential interest rate cuts by the Fed will affect the mortgage market?
So they have some relativity to each other, but they're not directly connected. So that you understand, the mortgage rate and the federal interest rate and the mortgage rate, while they have some relativity to each other, they're not directly connected. So your federal interest rate is going to dictate the money that banks can lend at. The mortgage rate is going to be directly impacted by the purchase of mortgage bonds. So the mortgage bond market in the background, you're going to have investment portfolios. Sometimes it'll be 401ks, a lot of private interest groups, as well as some individuals that will buy a packet of mortgages at a time. And the rate that they need to receive their investment return is going to be what really truly controls that rate. So we've had incidences even just in 2022 where the mortgage rate, where the interest rate increased. I believe it was like by 75 basis points. It was the second time we had that huge jump.
Yep.
The next week, mortgage rates dropped by 0.5%.
Oh, interesting.
Only for a short period of time, but they were basically being sold larger packets. And so they were willing to take on additional risk at a lower return because there was more in that portfolio for them to invest in.
Interesting.
So they are not going to be directly interconnected. And for any questions on that, if you want more deep dive details, any excellent loan officer is going to be able to explain those in more depth to you on a one-on-one basis. But ultimately, the amount that somebody is willing to receive as a return is going to be what controls that.
That's a great point you make. And I think evidence of that is what has happened just very recently.
Mm-hmm.
We have been waiting anxiously for interest rates to drop for how many months since the last increase?
Right.
They've just been steady for several months, but they keep talking about the Fed dropping interest rates in their next meeting, and that's been going on for at least a quarter now. It looks very promising now that they are going to drop them in September, this month.
Mm-hmm.
I have been watching mortgage rates, which peaked near 7%, and I just saw someone advertising a below 6% mortgage rate. Interest rates haven't changed yet, but the mortgage market has in anticipation that those interest rates will drop.
Interesting.
Well, and so the mortgage rate is really going to be more indicative of demand as well as risk, right? So when your unemployment numbers are looking really good, that's going to obviously improve your interest rate on a mortgage because, again, we're talking that cash on cash today return versus that long-term annualized, right? We're looking a 30-year return on a portfolio packet. So a 30-year longevity means we're not as worried about this, but we're concerned about the more or less the 8-10-year rolling average of what's forecasted. What's going to happen? What are going to be the economic downturns? Where are layoffs going to happen?
Right.
What are the chances that Mitchell getting a loan today is going to be able to pay that loan still in 5 years, right? If he has a high default risk, I need more money on the front side so I know that I can recoup my cost and my risk in that property, right? And so maybe that's a better way of wording that. And I don't know if you want to read the question.
No.
Where we look at that. But truly, that's going to be your end game. The mortgage rates are going to be based off of a long-term hold pattern. They're not going to be presumptive in a 1 to 5.
And just for our audience's benefit, he mentioned just a bit ago looking for a good loan officer, loan mortgage company. And I've got one in Utah that we've used from time to time, and I haven't bought a home in a year and a half or more, but I'll call him and say, hey, his name happens to be Dave Ramsey, which is funny. It's not
That
Dave
not
Ramsey.
that Dave
Not
Ramsey.
that Dave Ramsey, but
That's really
Dave is terrific. I'll call him up and say, hey, I just got a question. And he knows I'm not in the market for a mortgage, but he's willing to answer any questions about mortgages and what, going up or down, or how can we, theoretically work around this issue or that issue. And it might be I'm asking for a family member or for some other reason. But a good mortgage officer, like a good real estate agent, like any good advisor, should take the time and answer your questions without you feeling like, oh, he just wants to make his next buck off of me, and so he's not willing to talk to me unless I'm actually applying for a mortgage.
Right.
So look around for good mortgage people, just like you look for a good real estate agent.
someone you can consult.
Definitely.
Yep. Number 5, what options do current homeowners have if they're struggling to make mortgage payments due to the economic downturn?
So there are a variety based off the types of loan products you're in. The quickest, long, and short, a lot of iBuyers, a lot of the instant cash offer firms, as we touched on briefly before, are ones that are really good initial resources. I will tell you in that regard, and not just because I'm an agent, you are able to work with a real estate agent when you're working with these iBuyer firms typically. And I do strongly encourage it, just like going into new construction or trying to sell the home on your own. You don't understand all the regulations, and typically the iBuyer firms, most of them, will also pay an agent's commission or a portion of it to be able to go through the process. And that way you do have the protection. You do have that second set of eyes that can read through the contracts, because they don't typically use the traditional real estate forms, in particular in the state of Arizona and in a few others. They're going to have modified, or they'll use the state form, but it will have an addendum to it that overwrites and supersedes almost every term that's in the initial contract. And so you want to make sure that you just know what you're looking at. So either an attorney or an agent that can protect your interests and fully understands the contract and contract law is imperative to have in that situation.
Awesome.
We have a son who lives in Connecticut, and he's in the process of buying a house. My experience with those Eastern Seaboard States, not just Connecticut, but they don't do any real estate transactions without an attorney.
Right, because those are attorney-driven states. So in the state of Arizona, state of Texas, honestly about 50% of the states, the real estate agent is legally permitted to practice law in regards to drafting a real estate contract. Okay. It is going to be governed, obviously, and regulated by the broker at the office to ensure that it adheres to state and federal guidelines. But you're able to do that. In particular, Arizona, for example, we already have our template forms. So it limits some of our liabilities in that regard, as long as we're using the forms that are released by the Department of Real Estate. However, along the Eastern Seaboard, as you mentioned, there are states that are attorney-only states. So the attorney has to draft the purchase contract up. And so they'll go through there. They also typically in those states will not have a third-party title company. They'll have the attorney's office that does all of the contract as well as managing the overall transition of ownership from one party to another.
Interesting. Thank you.
Of course.
All right. Next question that we've got. With rent prices skyrocketing, do you think it's still more advantageous to buy than to rent?
So again, and I hate to say this, but it really depends on what your goals are in that situation. If you don't know where you're going to be staying, if you don't know where you're going to be for the next 1 to 3 years, renting is a very viable option, right? The cost of renting right now, while it has skyrocketed, it doesn't really survive much difference in the cost of owning at this point in time, minus the liabilities of maintaining the property,
Right.
updates for repairs and that sort of thing.
Yeah.
So if you don't have a healthy reserve to know that if the AC goes out, that I can fix it if the home warranty company isn't going to, or a water heater or something of that nature, if best way I can word it is, if a $2,500 home repair is going to make you scramble and miss a mortgage, rent. That's
Good point.
case in point.
Yeah.
The other half to that is, again, if you're 1 to 3, maybe possibly only up to 4 or 5 years in that property, the question mark is, how do you feel the status of the market's going to be at that point in time? Yes, we had an explosive growth 2020 to 22. Then we had a really, really exciting burst mid-22 into 23 in
Right.
values. We've stabilized since then, and we've had a very moderate, very mild growth and appreciation over that time.
Mm-hmm.
But is the growth and appreciation going to offset your origination costs and everything else and your interest rate on that home?
So if you're just trying to time the market, like, oh, I'm gonna rent right now until it goes down, you might be renting forever because we don't
Right.
know when it will go down.
If you're looking to buy a home for yourself, you're okay with if you had to stay in that house for more than 3 years, then it's not a bad time. You're going to have basically the same out of pocket minus any sort of, like I said, water heaters, that sort of thing.
Cool.
It's going to offset each other as far as value. You're not going to lose money on owning instead of renting at that point in time. Highest viability, I should say. But as expensive as rent is, get a quote on a mortgage and all your monthly costs on it, your PITI payment, your principal, interest, taxes, and insurance payment.
Right.
When you do that combined payment plus the HOA,
Sometimes
typically it
renting
still is a little bit cheaper to rent, even though it's an insane amount of price.
interesting because you take all the
Yeah.
liability off.
That's
Well,
right.
and you have to understand, most people that purchase the home, even if it's with a mortgage, they probably bought the house when the interest rate was less than 4%. So your cost of acquiring a new loan today, plus your out-of-pocket origination costs and everything else is pretty high. And while we did talk about the reduction in interest rates, the vast majority of first-time home buyers, they're looking at taking advantage of a down payment assistance program that has an increased interest rate in order to offset that cost, to reimburse. The money's not free. Let's just be
They've
real.
gotta
It's,
make their
it's
money
not
somewhere.
free.
Yeah.
So they need to absorb that cost and a little bit more to keep the bond purchasers happy. So you're going to pay that money back and then some, and that really skyrockets the cost of a house. You're talking
Interesting.
8-9% interest is where a lot of those down payment assistance programs are sitting right now.
And there again, it depends on the market you're in as well,
Mhm.
because that ratio between how much is it going to cost me to rent
Yeah.
versus the same house, how much is it going to cost me to buy it month to month, may not be the same in every market. You know,
Yeah.
sometimes the rent's higher than the mortgage payment. Sometimes it's the other way around. So you need to look at that and evaluate. Again, look at the numbers,
Mhm.
even though we all hate to do that, but you got to look at the numbers and really look at what you want out of that house.
Definitely. What's the
Awesome.
end goal?
Yeah.
Every time.
All right, as we land the plane here, we're coming to the end of our time. I'll offer up this last question. Just think about everything we've talked about. What would you say your last bits of advice are to those that are trying to buy a home for themselves?
Know beforehand what your goal and your exit strategy and timing is going to be. That really is going to be the answer to everything. If you don't know what you want to do in the end, you just, hey, my parents said I should buy a house. Why? really understand that homeownership is the American dream. It's not the American requirement, right? We all want it. And as an agent, maybe that sounds counterproductive for me to say, maybe you shouldn't buy a house, but I want to make sure that if you're doing it at the end of the day, that you don't want to cuss me out because you did it because I encouraged you to, right? It's really important that you understand the risks. It is a risk to take it on. Just like it was a risk back in the early 2000s to buy stock in Yahoo or Google, right? No one knew that they were going to perform that great. And out of how phenomenally they performed, how many stocks did people buy that didn't, right? So there's always going to be a risk factor there. It's what do you want to put into it? What are you comfortable with putting on the table? And understanding that right now, there is not a big variance between the cost of renting and the cost of homeownership.
Awesome. So know your goals, know your risk tolerance
100%
before going into it.
And find the right people to help you.
Absolutely.
Cool.
Absolutely.
Good agent, good mortgage person.
Amazing. And guys, we hope that you have gained value from this interview. Please like, comment, subscribe. Any questions that you may have had or that you have for Jeremy, please leave them in the comments. Questions that you have for me or Pops, we're always happy to address those questions, and it gives us a good idea of future guests that you might want to have on.
Thank you very much. We appreciate you tuning in and look forward to seeing you again.
Appreciate you guys having me.
All right, take
Thanks,
it easy.
Jeremy.